Hey, welcome in. Listen, today we're going to talk about the data center crisis. So every time you go to AI, hopefully you're using AI because it is very helpful, but every time you ask, write me a dad joke for the day or something like that. It's the equivalent of turning on 10 hair dryers in Virginia or Texas or some other data center location. So, we're going to talk about the energy demands and the data center crisis that could be brewing that is involved around energy markets here in the United States. So, will AI demand break the US natural gas grid by 2027? So here is a little something. Let me expand this. So this is a history of 2016 to 2022. And what you can see is a relatively flat natural gas powered demand curve. So this is what we watch in the energy markets. And it was relatively flat. If it was a little warmer than normal, had a slight uptick in electricity because of air conditioning load. So, but then something happened. And this is what happened in 2021, 2022. AI started getting off the ground. And what you notice is it grew by 5%, then another 5%, then another 5%. 2025, we kind of flattened out, and there's a big reason why, and I'll talk about that in a little while. But the key thing is that electricity demand is growing. It's growing at every residence. It is growing with EVs. It is growing around AI, and AI has the potential to take 30% of the natural gas market and double it. So that is what we're looking at. So this is a massive new, pardon me, massive new energy demand and U.S. electricity consumption, which has been flat for decades, and suddenly is surging. And guess what? Our electric grid was built decades ago. So this growth was not really anticipated in the way that we built the grid. The grid is going to become even more fragile in years to come. But natural gas fired power is the backbone of reliable 24/7 electricity. And I'll explain what that means in a little bit later because, yes, we do have renewables that are into power, but electricity is either consumed on the spot or sometimes stored in batteries. A lot of the battery technology is still trying to grow, but it's got a long way to go. So we're not quite there on renewables making a big dent. Natural gas is kind of the key backbone. So we're looking at also the natural gas market in the United States from local markets to global gas player. In 2016, we maybe had 2%, 3% of, of our supply exiting the country via LNG. It is now 15 to 20%, and it's growing even higher. So in the 20th century, there was a lot of localized demand on natural gas based upon supply in the US. And we would get imports from Canada and we export to Mexico. But LNG has come from a small player on the natural gas stage to a very large one. So this combined with the excess supply that we achieved with the shale boom in surplus supply, the US began LNG exports. And then in 2023, 24, we became in the United States the largest LNG exporter, and prices started linking internationally. And for reference, when the US is priced $3 to $4, European prices may be 11 or 12, and there is a LNG marker called Japan Korea marker, which is Asian prices are usually around the same level, but sometimes a little bit higher on a seasonal basis. So then we had an explosive LNG export growth, and they surged over 21%. And that was the export surge in the first half of 2025. Golden Pass is expected to add another 2 BCF a day. We currently have 17 BCF a day of capacity, but they can overrun that. Right now, we're exporting close to 19 BCF. So add another 2, that's a lot. Now we'll save this for another video. There is a potential for some LNG crowding, which could bring LNG or natural gas back to the United States, which would be very bearish for an output. So we have this massive expansion on the LNG side. So what does this mean for natural gas markets? It means a global impact. There is a supply flood of US, Qatar, and Australia. Australia, a lot of people miss, but those three countries represent the lion's share of LNG around the globe. And LNG is growing because power is becoming more important, not just in the US, not for data centers, but everywhere. And there's a 42% growth that is expected in LNG supply. So notice we're talking supply, not demand, and that's what I'm talking about in the springtime, which could be an issue for natural gas markets. But like I said, we're not going to talk about that today. There is price pressure that is squeezing a lot of the export margins. Okay, now let's pivot. So we talked a little bit about supply, a little bit about exports. Now the AI data center boom. The commercial electricity jumped 3% in 2024, and then another 2% in the first 9 months of 2025. Latter half of 2025 did kind of moderate somewhat, and there has been a seismic shift. And a lot of this has to do with the existing power capacity, which is what is starting up a wave of Meta, Google, Apple, X, all of Elon Musk's companies. Now I'm losing track of which ones, but Amazon, all of these are building data centers. These are going to be massive, massive scaled transactions that'll bring so much electricity, but it needs to be fueled by natural gas, or doesn't need to be. Most of them are planned to be fueled by natural gas because there is a predictable supply base and a reasonable cost, because natural gas as a feedstock for electricity is going to be the highest component in the profitability of AI going forward. So the cost of electricity is super important. It's going to be important for everybody's electric bills. It's also going to be important for all the AI, the AI creators, Google, Amazon, and so on and so forth. So the massive power appetite. There is potential for 10 times more power. Let me say that again. We would take 30% of the natural gas market today times 10, so a 300% gain on natural gas consumption if most of these are focused on natural gas, which by experience most of them are. There's a lot of large projects, such as 2 gigawatt projects. 3 Mile Island, Microsoft actually bought that and is starting up nuclear power to feed its AI. So this is big. And this Google is running searches on AI that would consume electricity equal to the amount of electricity in Ireland. So these are massive projects. So the projected server deployment, over 1.5 million servers deployed by the year 2027. That is massive. So when I talked about 10 hair dryers, think about 50 of them for every single one of those. Can you imagine the electricity consumption? This is why when fossil fuels and renewables haggle over which one is superior, the fact is, for AI and electricity, we need it. We need every bit of electricity that we can generate. So all the renewable and all of natural gas, we need all of it. 85 terawatt hours is the expected power consumption by these servers. This is a massive shift. So the data center hotspots, Virginia, Texas, Ohio, and Oklahoma, all of these are conveniently situated close to supply. And that is the key thing. A lot of the natural gas supply is close to Virginia, Texas, Ohio, Oklahoma. Virginia is probably the furthest, but it's not too far from the Marcellus and Utica. So let's look at the grid strain emerging. So we have normal growth, strain, and emergency. I would argue that we are in strain right now. And I'm going to show you something that will talk a little bit about grid stability and renewables when it comes to natural gas and the architecture of what we have in today's environment. Right now, there is consumption of so much electricity, so much data, data center computing capacity, that many of these facilities are built between 5, 7, some 10 years, depending on the scale. So this is creating an infrastructure gap. So is natural gas the solution? Is it coming to the rescue? So power demand and AI for 24/7 appetite, it becomes a reliable baseload, and natural gas offers a scalable, dispatchable solution, deployable relatively quickly. It's good on economics and it's good for power generation, but it does have limitations, and I'll get into that in a minute. So bring your own power trend. So we have overstretched grids. Traditional utility infrastructure can't keep pace. We have dedicated generation. Hyperscalers are partnering to build on-site gas-fired plants. So this is really interesting because you have power and upstream pairing up in some locations. There's some in Louisiana where this is getting off the ground. So these become guaranteed power. And I say guaranteed, but it's not really guaranteed. We just have Winter Storm Fern. And to give you a reference, when production comes out of the ground, there's a lot of mechanical devices and mechanical things, and cold weather can impact it. And that cold weather took natural gas supply from 110 BCF a day down to 90 over 3 days. So that doesn't give you guaranteed, it doesn't give you 365 days of uptime. So there are a lot of infrastructure problems that need to be covered. And that is something that a lot of hyperscalers and a lot of industry is failing to see right now because that problem doesn't exist quite yet. So some major gas power projects. Entergy and Meta has a 2.2 gigawatt gas capacity for a $10 billion Louisiana data center, which is about 400,000 a day or zero point 0.4 BCF a day. Chevron has 7 new gas turbines by 2027 to supply US data centers. And ExxonMobil has a 1.5 gigawatt, 1.5 plus gigawatt off-grid gas plant with carbon capture. So these are not even hitting the overall interstate pipeline system and market. These are being connected before it ever gets there. So it's pairing upstream with that power. Some of the midstream companies that are capitalizing on this, you've got Williams, you've got Energy Transfer, Kinder Morgan, Enbridge. A lot of these are infrastructure. TC Energy in Canada. That's going to be an interesting one, especially with all the energy that is produced up there. So these are projects that are coming down the pike, and these are the companies situated to build out the infrastructure for these big power projects. So the projected gas demand from AI, US AI data centers could require an extra 8 BCF a day. I think that's low. It could be as much as I've heard 50 BCF a day. And for reference, we currently are providing 30 to 40 BCF a day for natural gas. So even 10 would be a 25 to 30% increase. So if we go to 50, we're talking about more than double the natural gas that we need. So you add in LNG and you add in exports, this gets very interesting very quickly, and interesting as far as I think there's going to be opportunities for natural gas markets around this. So roughly a 9 to 10% increase over today's gas consumption. And again, I've heard 50 to 100%. So that's what I've heard from industry folks. This is not from press releases. This is not from any other sources. We are embedded here at Energy Rogue in the energy markets, and that's what we're hearing. That's a word from the street. So who stands to gain? midstream and infrastructure, gas producers, utilities, and equipment manufacturers. You've already seen that with NVIDIA. This is the energy side of that expansion. So NVIDIA expands on the chips, midstream and infrastructure. It needs to be built. Gas producers, because prices are probably lifted. Utilities are benefiting because they secure new revenue. But how this links with residential, commercial, and other electric power consumption, that remains to be seen. That's going to be interesting to play out over the next decade. So some vulnerabilities ahead. Regional constraints. The Northeast has a lot of fossil fuels, and but there is a lack of not a lack of supply, but a lack of supply getting to the right places. So this overbuild could create new constraints, and you have new basis disruptions. And when I say that, think about it this way. Many people look at NYMEX for Henry Hub. Henry Hub is a location in Louisiana. There is places in the United States, and when Henry Hub was 3 or 4, where the basis was $15 to $20. So that means the natural gas commercial, not even the utility, what people are paying on their utility bills, but and this was predominantly in the Northeast, but there's a location that the basis was $15. So let's take that in relevance. You have an $18 natural gas price in the United States. And I referenced before Japan, Korea, and Europe. And both of those are trading at about 11. So during the winter, there are higher than LNG type prices, and that is due to constraints. The gas and the power can't get to the right places, and that exists. Let me give you a perfect example of this. So on peak days, when more gas is needed, the pipelines can only supply so much of what is in the pipeline already. Then it has to be replaced from storage. What I've got here is an image. These are all the storage facilities close to New York City. The closest storage facility is roughly 200 miles away from New York City. Natural gas only travels at 17 miles an hour. So that what that means is it's going to be 10 to 12 hours before natural gas gets filled, which means we are staring at power constraints, we are staring at furnace constraints, and these constraints are getting more and more sharp. So the infrastructure is handling it right now, but it is it is at that strain that we talked about earlier. So what is the outlook 2030 and beyond? From 2025 to 2027, a demand surge, regional bottlenecks emerge, and potential price spikes. 2027 to 2030, LNG oversupply is possible. Production must reach 130 to 140 BCF a day to meet demand. 2030 to 2040, gas consumption peaks in the early 2030s, and LNG growth levels off. And that's where efficiencies gain. So for the next 4 years, this is going to be a very fast and furious electric markets, natural gas markets, and data centers, AI. This is moving so fast that these scales, it might not even take to 2030. But 2040 to 2050, probably a decarbonization scenario and carbon capture required with hydrogen transition. So what are we looking at? Balancing act. You have low supply and high supply, and low demand and high demand. So in the low supply, high demand, you have AI data centers. In the low supply, high supply, LNG exports. Okay, low supply and low demand, production growth, and low demand, low supply, infrastructure investment. So that is where our balancing act exists. And this is really the genesis. This is going to be a wave of infrastructure that is needed. One thing that has been avoided to date is our power grid probably needs to be rebuilt. And we're probably talking, when we're talking about all the budgets that our government fights over, this is going to dwarf that. This would be a massive, massive investment because our electric grid was quite frankly not built to do things that we're doing right now, that I'm delivering this via an electronic medium that didn't exist when we built the electric pathways to get it there. So bottom line, the market is adapting quickly. We're going to have a critical test by 2027, and we're going to have dual tailwinds. So listen, my name is Brian. I'm with Energy Rogue, and listen, we cover energy markets, specifically crude oil, natural gas liquids, refined products. If those are of interest to you, you can click the button down below and get our lead, our mastering oil and gas markets, and this will give you a lead in to how to master the oil and gas markets, because you can spend 40 hours a week and still not even make a dent into the energy markets. We're going to show you pathways around that. That is in the link down below. And before I leave, a topic we're going to cover, I'm not sure if it's next week or the week after. Drop me a comment. Let me know if you want to talk about that. Talk about this. This is my business partner, Bill. He is on the road, and he's going to tell us a little bit, something interesting. This is Tales from the Road. So let's listen in.
Hey, Brian. Hey, I'm out and about, and as you can see right here, if you'll take a close look, I'm on Route 66 in a little town called Yukon, Oklahoma. So why is this important? Well, in 1926, Route 66 was formed. So it's now 100 years old. So why is that important? Well, 100 years ago, we were just really getting the automobile where to go. And believe it or not, Brian, all of our refineries right now, the ones that are in existence, average over 100 years in age. So 100 years ago, refineries that are operating today were operating 100 years ago when Route 66 was coming in. So now why is that important? Because all the technological changes that happened since then has changed how refineries do everything. And so let me tell you, it's going to be a different world in 100 years from now. And more importantly, in the next 5 years, we're going to see significant changes. And one of them is going to be around natural gas. Now take a look. No coat, no sweater, nothing. It's February and it's warm. That's going to have a big impact on natural gas for the next couple of days and probably for the next 15 days. Then we got a cold front coming in. But let me tell you something. I've been looking, I've been studying. Big changes are happening in natural gas. Some of the stuff is going to happen within 3 years. And it's going to make the world a difference. So, hey, listen, stay tuned to us and subscribe to Energy Road if you want to see what we think is going to be happening in the next 3 years. And let me tell you something, it'll surprise you. Bill Shanahan, and I am out on Route 66.
That is awesome. So listen, if you do follow energy markets or it's important to your business, we do have a couple of subscription services. There's some more information about that down below. Otherwise, get the free ebook. It's about 40 pages. So I hope to see you inside, and I'm looking forward to it. And I hope you have a fantastic day. And thanks so much for spending some time and talking a little bit about data centers, power, and natural gas, because there's a lot of changes, and those changes are coming about very, very quickly. So thanks so much. Hope you have a great day. Be kind and be patient, and enjoy your day.